Hey everybody, it's John Lone King. It is Friday, the 24th of October. 1 week left until we hit Halloween, and 5 days left until the Fed makes their next announcement at their meeting next week on the 29th. So let's dive in and talk about what all of this means and what's going on this week. So first and foremost, we got a report from the federal government, which is not expected when the government has shut down. So to remind you, your federal government has shut down. Only essential services are running as of October 1st. The government does not have the authority to run because there isn't a balanced budget, or they've run out of money, essentially, even though they print the money. Anyway, we won't get into the politics of it. The fact of the matter is the federal government called back the Bureau of Labor and Statistics, a small crew specifically to create one of the inflation reports that comes out each month. And that inflation report was critical for Social Security, because every year in November, Social Security Department needs to determine what is the inflation number that they're going to use, and they need to get the inflation number over the last year, because the fiscal year for the federal government ends on September 30th. And so they needed that number so that Social Security, which is an essential service, can be able to update how much people are going to get in their Social Security payments starting on January 1st. So they released that report this morning. There is good news and there is bad news in that report. So first of all, inflation overall is lower than what it had been trending. So that is a really, really good sign, because it's the only official report we're going to get all month. It's the only official report that has anything to do with what the Fed cares about. And there's lots of reports they normally digest when they are going to meet, and they're having their meeting next week on Tuesday and Wednesday. So this report, being the only report they're looking at, could have been a major problem if it had shown inflation had spiked. But there's some weird things in there, because they created a version of the report, and they kind of call it the super core, which says, hey, let's get rid of things that core inflation is getting rid of volatile things like food and energy, because food and energy jump up and down on a regular basis. And so they said, hey, core inflation, we get rid of food and energy. But now they've got super core that is getting rid of any tariff impacted numbers. So therefore they're saying, hey, let's pretend that the tariff didn't happen, the tariff issues aren't happening, and that what would inflation be if we didn't have tariffs going on right now? Well, that number technically is higher than what the trend had been. And that's really weird, because tariffs, in my mind, would have caused more inflation. And so stripping it out means there should be less. I don't understand how the government comes up with the numbers, but here's why that matters. Okay. It matters because technically that's something the federal government could argue to say, hey, inflation is actually going up, even though going up higher than what it had been. So inflation, any inflation means prices are going up. But the amount of inflation, the amount that prices are going up compared to last year is what they're talking about. And that is a concern. Now, the 10-year Treasury, the mortgage market overall has reacted positively. And we're seeing rates staying at the lower end of the range that we've seen all year. That's really, really good news. What we don't know is what's going to happen next week. So when we look at this, falling inflation means rates are going to be likely more stable, if not lower, because the Fed now can shift more of their focus towards the jobs issue. So the jobs issue, as we've been talking about all along, is the concern that jobs are not being created as robustly as they had been in the past. And as a matter of fact, maybe there are job losses, which is essentially potentially leading us into a recession. The Federal Reserve has two main jobs. I say this over and over again: to keep prices stable, that means inflation in check, and to keep people fully employed. That means keep unemployment low. Well, the jobs report, that we haven't gotten a jobs report in literally almost 2 months. The last report we got was the first Friday in September. That covered August jobs numbers. We were supposed to get a report the first Friday in October. We didn't, because the federal government was shut down. We're supposed to get a report 2 weeks from now, which is the first Friday in November. We're likely not to get that report. As a matter of fact, Trump said something, I think this morning or yesterday, saying, hey, don't expect any more reports. Maybe it wasn't Trump. Maybe it was Jerome Powell. But somebody said, hey, don't expect any reports anytime soon. Pretty sure Trump said it. So he's basically saying, hey, I don't expect this government shutdown to get resolved anytime soon. Okay, that's a whole political foray I'm not going to get into. But what I am going to tell you is that means that everybody's operating on lack of information. It's like driving at night without headlights. Okay, you're trying to drive, you can see, but you can't see very well because you don't have the headlights, and so you can only see so far in front of you. Or one of your headlights are burned out, or your brights don't work, and so you can't illuminate as much in front of you. And so it's really a handicap. It's a challenge for the Fed to lead the economy when they're missing the data that they need. And so next week, we've got the Fed. Actually, the Fed is looking for data to make decisions, and then they tell us what they're thinking based on that data. Well, because the Fed and the market doesn't have any data, the Fed has to make decisions based on a lack of data, but the Fed's decision becomes the data that the market is going to use to determine if rates should go up or down. Say that 5 times fast. Okay, so no data out there, very little data that you can believe. There's private data. Some people argue the private data is better, but it's skewed. So is the government data, but they trust the government data, and there isn't any. And so normally the market says, well, I'm looking at the data and I'm looking at what the Fed says. Well, the Fed looks at the data. The Fed still has to say something next Tuesday. And Wednesday, whatever the Fed says is going to be based on a lack of data, which means it's based on emotion. And then you got the market that's going to react to what the Fed said. And the Fed meets again in 6 weeks. So we're talking about, I believe it's December 10th that the Fed is meeting again. And so that is creating a lot of uncertainty in the marketplace. And that is the biggest concern going into next week. 11 a.m. Pacific time on Wednesday is D-Day. That is when the announcement, the press release comes out. And then at 11:30, Jerome Powell gets on stage and or in front of the podium, and he starts talking. And whatever Jerome Powell says, the markets are going to react pretty violently, as has been over the last few Fed meetings. So expect a wild ride next week. If you're in a position where, hey, I can lock an interest rate on a mortgage for a refinance, or I've got a purchase and I'm kind of playing the market to see where rates are going to go, it appears we're going to see favorable rates between now and Tuesday. All bets are off on Wednesday. I think it's going to be favorable. I think the Fed is going to say, hey, inflation still is under control. We've got some private data that says that employment is not in good shape and that we are likely to continue lowering interest rates. Something along those lines would be amazing. If the Fed says, hey, we can't see what's going on with unemployment, so we're going to assume everything is okay. And we see this inflation report from last week. And when we strip out food and energy, and we strip out the categories that are susceptible to inflation, to tariffs, then we see that inflation is actually growing, and we're super nervous about inflation. If he says something like that, it's really bad news for us. So it's really easy for this to go either way on Wednesday. If you're a betting person and you like to gamble, ride your way through it and see what happens. There's a good chance you're going to win on the other side. But you also have to look at the fact that if you lose, what's that going to cost you? If interest rates go higher, will you no longer qualify? Does it take away the benefit that you were getting from refinancing? Because if you're paying 7% right now, and you have the option to get that down to 6%, and you wait, and it goes to 6.25%, and therefore you don't refinance, well, guess what? You're not losing the 6.25%. You're stuck at the 7. Okay, you're stuck paying 7% for longer than you needed to. Maybe you take the bird in the hand and lock right now, because nobody knows what's going to come tomorrow. And that's the hardest thing about refinancing. Speaking of which, when we look at tomorrow, not literally tomorrow, but rates change every single day. We have no idea where they're going to go. We have no idea all of the different factors and which factors are going to pull the strings in which direction. But I will tell you, there's a major factor that drives interest rates that I rarely talk about, and I want to dive deep into it today. And it's called loan level price adjustments. And here's why. Because the FHA signaled, the FHFA, the Federal Housing Finance Administration, they oversee Fannie Mae and Freddie Mac. They have announced, Bill Pulte announced on X, Twitter, on Wednesday, that they are going to do a full review of the LLPAs. What is that, John, and why does it matter? That's what I'm going to explain for the rest of this live stream. So let me be really, really clear. First of all, none of this is guaranteed to happen. Nobody knows what's going to happen. But there is, call it a tax that is charged in your mortgage that the federal government charges via Fannie Mae and Freddie Mac based upon the risk of your loan, specifically your down payment or loan to value, how much equity you have remaining in the property, and your credit score. But there's other factors that they look at. Now, before I dive into specifically what this means, I want to give you a bigger picture of what's going on with Fannie Mae and Freddie Mac, because that's actually really critical right now. So Fannie Mae and Freddie Mac were two private entities, two private companies that basically bought mortgages and resold them on the open market and became the de facto keeper of mortgage guidelines. And back in 2008, when the Great Recession happened, Fannie Mae and Freddie Mac got taken over by the federal government. They were deemed too big to fail. They were deemed that, hey, the housing market in the United States would crash if Fannie Mae and Freddie Mac went under. And so the government rescued them, but the government took them into conservatorship. Conservatorship is essentially what happens where a judge says, you can't be in charge of yourself. I have assigned a conservator. That happens to people who have diminished mental capacity. So you might have an adult who had a car accident and they have diminished mental capacity now, and they've been assigned a conservator that is essentially in charge of them, makes all financial decisions, essentially takes that adult and puts them back into the status of being a minor, where your parent makes all your financial decisions, except you're not a minor. You are still an adult, and another adult is put in charge of making financial decisions for you. That's what a conservatorship is. Now, the federal government put Fannie Mae and Freddie Mac into conservatorship. They are private companies. They still have stock, but Fannie Mae and Freddie Mac got taken over by the federal government. And so there's people who've owned their stock for years, but they haven't really made any money off of it because the federal government keeps all of the profits. Hey, I'm in charge of you. I know what's best for you. When you make a profit, it goes to me. Well, that seems kind of backwards. That doesn't seem like the right way, but it is in fact how it's been working. Well, now President Trump is pushing to get Fannie Mae and Freddie Mac out of conservatorship. And so they're going to become for-profit companies if Trump gets what he wants. Now, that's a huge win for the federal government financially, because the federal government is going to be the recipient of the IPO money. So they're essentially going to do an initial public offering to sell the stocks of Fannie Mae and Freddie Mac, and the government will still retain partial ownership from what I understand. And they're going to make a bunch of money by selling the stock. But now they become for-profit organizations. Now they have to drive profitability for their shareholders, which is what they had to do prior to the Great Recession. And why does all that matter? Because what they're talking about right now is a mandate from their conservator, the FHFA. That is literally what the Federal Housing Finance Authority is the government entity created specifically for the purpose of overseeing their new children, Fannie Mae and Freddie Mac. And the FHFA has a mandate saying, hey, we want to lower mortgage fees and make it cheaper for people to borrow money. That's great. But what's going to happen when the private market takes over? Are they still going to follow that same mantra and that same thinking? A gentleman named Barry Habib has stepped in. He actually he's been a long-time financial analyst and guru in the mortgage world. He's written lots of books. He's a very smart gentleman. I followed him for a long time. He is now a board member of the Fannie Mae's board of directors. So he's got a lot more influence. He just became a board member back in July, and it's my understanding this is his brainchild. So what does this mean? Well, let's talk about what LLPAs are. So an LLPA, I'm pulling up this chart right here, and I know it's blocked a little bit by my banner here, but you should be able to see it. A loan level price adjustment is for loans that are sold to Fannie Mae, and they're assessed based on certain criteria and eligibility. So these are the risk factors that you pay when you are taking out a conventional loan. And there's three different categories. Purchase money loans, which says, hey, this is how much extra you're paying in fee, not interest rate, but in fee, and that fee goes to Fannie Mae and Freddie Mac, which ultimately goes to the pockets of the U.S. Treasury while they are in conservatorship. And so it says, hey, if you've got a really big amount of equity, in other words, you owe 30% or less, than what the house is worth, then no matter how low your credit score is, you get the best deal. Okay, everybody gets the same deal, no matter if you have great credit or bad credit, because you have so much equity in the property, it doesn't matter. But if you have 20% down, and everybody says, well, 20% down, that's the best deal, is having 20% down on a property means that I'm in good shape. I'm low risk. You are not low risk. Even if you have the best credit score out there, you still pay a higher fee for your loan. If you have a 780 or better credit score, you're still paying a higher fee when you put 20% down. Now, if you have a 700 credit score, you're paying a significantly higher fee. So you see these adjustments are going up significantly. And you might say, my gosh, John, I'm putting 20% down and I have a 700 credit score. What more do you want? Well, if you ask the federal government, what more they want is 40% down with a 700 credit score, or they want 25% down and a better credit score. That is what more they want. These numbers were made significantly more expensive 2 years ago. In 2023, the federal government, through FHFA, stepped in and said, we want to split this out. We don't want everybody getting the same deal. We're going to make it way more expensive for most people, but we're going to make it free for people who are first-time home buyers that are low income. And so right here, they created this chart called LLPA waivers. And it says, hey, if you're doing a home-ready loan, which is basically for low-income people, you get no loan-level price adjusters. You don't have to pay this tax. If you are a first-time home buyer and you make less than 100% of the median income in your market, or 120% if you're in a high-cost area, you don't have to pay any of these adjustments, or if you meet any one of these 5 rules, and I won't go into what they are. But what I'm telling you is they're rethinking this whole thing. And these get really expensive when you're looking at refinancing, whether you're refinancing without pulling cash out, which is really weird the way they label it, but it's called limited cash out refinances, which essentially is a refi without pulling cash out. That's what a limited refi is no cash out. And this can get more expensive. So here you have perfect credit and you have 20% equity in the property. We're charging you 0.5% extra versus on a purchase. When you have perfect credit and you have 20% equity, you're only paying 0.375. But here's the kicker. You're pulling cash out and you have 20% equity in the property, you're paying 1.375 extra. So they've made it super expensive for pulling cash out of properties. I think that's one of the things they're going to likely change. I think another thing that they're going to change is they've made it very expensive to buy investment properties. So they've made the fee for investment properties really high. Like if you are buying an investment property, putting 15% down. I have a client today I was talking to, buying an investment property, 15% down. Fannie Mae charges an extra 4% for that fee. 4% of your purchase price. So if you're buying a $400,000 home, you're paying an extra $16,000 in fee in order to do that. But if you put 10% extra down, you save 2% in fee. I know it can get confusing, but the fact of the matter is these numbers are expensive, super, super expensive. It's often why I tell people, hey, sometimes we need to look at other loan programs. Maybe we look at loan programs that aren't backed by the federal government, or they're backed by FHA instead of Fannie Mae and Freddie Mac. There's a lot of different ways to look at that. But this chart has been tweaked many times over the last 10 years. It didn't even exist 15 years ago. Prior to the great financial crisis, great recession, this chart didn't exist. Everybody got the same deal. And then they said, well, that's not fair. Let's not give everybody the same deal. Again, I can argue both sides, but I do agree, hey, somebody with a 620 credit score and a small down payment is a higher risk than somebody with a 780 credit score and a big down payment. So if everybody gets the same cost, that's great for the low credit person, but it means the person with great credit is paying more than they needed to. They're kind of offsetting each other, and that's not fair to the person with great credit. And so I like the idea of the fact that, hey, you are rewarded with a better deal when you have higher credit and or a bigger down payment. But they've gotten kind of absurd with these fees. The federal government's made a bunch of money off of these fees, and there's another fee underneath this called a guarantee fee. That is a fee that is charged by the federal government simply through Fannie Mae and Freddie Mac for the fact that they guaranteed the loan, even though they're not truly guaranteeing it. So they're now called G fees. And there's a lot of concern that, hey, if these loan level price adjusters are reduced, they might just add to the G fee, which means everybody is paying more overall. Your higher credit people are actually going to pay extra because they're already getting, if you have great credit and good equity, you're already paying nothing extra here. They're not going to credit you money, which means if they're going to decrease these fees, they're going to make it cheaper for the higher risk transactions. That's a good thing, but don't wait until this comes out. That's the final thing I want to make really, really clear is, hey, who's going to benefit if these fees go down? It's the people with a lower credit score, potentially people who are looking to pull cash out of their home, potentially, but who knows when it's going to happen and who knows where rates are going to go between now and then. And most importantly, how much money are you wasting currently on the high interest debt that you're not paying off because you're waiting for rates to drop a little bit further? So many people have interest rates on credit cards in the 20, 25, 30% range. And they're freaking out because, hey, I want to rate 6.5% for my mortgage is too high. I want to wait until I get it at 5.5%. That's great, but you're paying 30 on your credit card debt. And so you have to weigh, what is my overall cost? What is my benefit? I am not telling you that it's the right thing to do. I don't know what the right thing is for you to do until I have a consultation with you, which is why this QR code is sitting right here. Oops, right here. Because my number one responsibility is to give you advice that belongs to your circumstances. It's like listening to somebody talk about medical advice online. Don't believe them, not because they're wrong, but because the symptoms and the circumstances are different than your symptoms and your circumstances. They're different than your medical history, and it's the same in the financial world. Your credit score, your home value, your current loan amount, your current interest rate, what other debt we're paying off, or if you're purchasing, what are your alternative scenarios and how much are you putting for a down payment? All of those things are different. And so as much advice as I try and give here, the best advice I can give you is scan this QR code and set up a time to meet with me to talk about your personal circumstances. I am interviewing for the job to be your lender. And so when you're thinking, hey, should I act now or should I wait? I don't know. And even after we meet, I won't know, but I can give you way better advice. I can give you my thoughts to say, hey, you're already getting the best deal. I highly doubt these changes are going to give you a better deal. Or, hey, if these changes came out, you might get a better deal, but you're wasting a whole bunch of money right now. How long are you willing to wait to waste all the money you're wasting today? So there's so much to go into all of this. The bottom line key takeaways is, look, the markets are shifting. They're shifting in our favor, but that could turn around very, very quickly. So if you're timing interest rates, be careful, because the timing of interest rates never, ever works out. Now, sometimes you get lucky, sometimes you don't, but you're never going to know what tomorrow is going to bring. And so if you say, I'm going to wait until rates are at this number, when they get to that number, greed sets in and you say, well, man, it worked. Wait for it to get down to 5.99 worked. Maybe I'll wait for it to get down to 5.5. Then when you get there, you're going to say, oh my God, that worked. Well, I should keep waiting then because it's worked so far. That's the psychological game we play with ourselves. And then you end up never doing anything and you have debt at 30% credit card interest rates that you've wasted a boatload of money, and it's also not tax deductible. So please set up a time to talk with me. Let's talk about what your options are. Let's talk through your scenarios and let's help you make smart decisions, whether you're looking to purchase or refinance a home. Thanks everybody for listening. Hope you have an absolutely wonderful weekend. We will talk to you next Friday on Halloween, and we'll see you soon. Bye-bye.